Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Chris Harvey of Wells Fargo writing, "There's growing crisis of confidence brewing. Stock market vigilantes will not be that patient or ignored. It probably needs to get worse before it gets better." Chris joins us now for more. Chris, good morning. Good to see you.
Good to see you too.
This is a really difficult one, so let's take a beat. Typically, we sit here and think about the kind of threshold that it would take for a policymaker to step in and act as the circuit breaker. This time, the policymaker is the source of the risk, maybe not the solution. How different is this as a moment for you and a team?
It's very different. And the issue is, and we go back to Greenspan before the 04 tightening cycle. He said, we can raise rates, right? But what we need to do is we need to communicate that to you. We need to tell you how we're going to raise rates, over what time period, so you can plan. If you're going to buy a house, you can speed up that house purchase. If you're going to buy a car, you can speed that up. This administration is talking a lot, but they're not communicating a lot. This weekend, we had one person saying tariffs are negotiable. We had somebody else saying they're non-negotiable. What are they? What's your goal? What you're trying to do? What are we handicapping? Over what time period? You need to communicate better. The other thing is the market is sending a big signal. It's not a good idea to ignore that.
China's sending a big signal right now as well, so I'd love your thoughts on that too. Big tariffs coming from the US side overnight. China responding with 84%. I think at the moment for a lot of investors, they'd look at that headline and say, you know what, given how little we sell to China, that's not much of a big deal. But I think the bigger read across, the bigger read through at the moment, that makes it much, much harder to get to the negotiating table with this president who's pushed back against China threatening to do exactly this.
Yeah, so what people have realized is the weak spot for the U.S. is the capital markets and the economy. If they push back, right, we're going to lose, and we are losing some negotiating leverage. What are we talking about? We're talking about recession. We're talking about job losses. We're talking about the negative wealth effect. We're talking, in a recession, the deficit goes wider, not tighter, and people know that. So they're saying, okay, fine. If we're going to do this, we're just going to pull everyone down into the muck. And what you're seeing is just not great.
Well, I'm looking right now. China also added 6 more firms from the U.S. to the unreliable list at the same time that we've seen incredible losses in the likes of Apple, which seems to be very much in the crosshairs of this. How much does this discourage you from going to the multinational companies, actually at a time when they potentially could be the most exposed? Yeah,
Lisa, what we need to do is we need to figure out exactly what we're dealing with. And because it's a moving target, that's why it's so hard to. That's why the markets are so fluid at this point in time. And you're right, where are the safe havens? The safe havens are at the front end of the curve. Safe havens are in low vol, they're in defensives. But even those are still, that's a place where we've liked, but it's still showing some stress, right? So it's very difficult to find a safe haven. It's very difficult to really preserve your money or your assets at this point in time.
Yeah, the reason why is because 10-year yields are up through 4.40. You're looking at 30-year yields now almost 4.9%.
Yeah.
They've absolutely been surging. What's going on? I mean, what are you doing with this?
So there's lots of talk. One conversation is that out of Asia that they're selling duration, right? So they're selling longer bonds and buying shorter bonds for liquidity issues to send a message. There's other talk about basis trades. There's, if you look at what's happening, nominals, last time I looked, nominals are going higher, but it's being forced by reals. It's not being forced by, at least in the last couple of days, by inflation expectation. That seems more like a liquidity issue, people moving around positions, not so much fundamental driven, right? The other thing is, obviously, we've got issuance coming, and there's more and more fear, even though right now, inflation expectations or break-evens aren't moving. There's fear that that will continue in the future.
Seeing some big moves right now, that's for sure. If you are just joining us, welcome to the program. 84% tariffs from China. China raising tariffs on U.S. goods to 84%, and the spillover immediate. Equity futures down by 1.6% on the S&P 500. The Russell down by 2.5. The DAX is down by 4 full percentage points. And in the commodity market, you're seeing crude roll over as well. On
on WTI and on Brent. We're down by 6%. Brent crude 58.98, WTI 55.85. There will be some individuals in America making a lot of noise today off the back of this headline. I'm thinking of the farmers in a few red states.
Absolutely, because remember Trump 1.0, the farmers were the ones that got hit the worst because they didn't have the export market of China to go to, and then the United States had to bail them out. But Jonathan, you started this conversation this morning when you're looking to policy makers for the answers, for the solutions. When I asked the president directly the pain threshold he was willing to take on for the market, he said sometimes you have to take medicine to fix something. They think the tariffs are the medicine. Well, what's going to be the solution and the medicine to what is happening right now, the fallout from these tariffs?
Some big moves elsewhere as well. Apple's had a difficult run of things. That name is down by 2% in the pre-market at the moment. Apple is down before today by more than 20% in just 4 sessions. The worst run for that name going back to 2000. The year 2000, the worst 4-day run in 25 years for one of the biggest companies on the planet. Chris Harvey, not to talk about single names exclusively, but we can talk about Mag 7.
Right.
Are they in a difficult moment now, in a much, much bigger way than maybe we've ever seen for those names?
So some, yes, and obviously Apple is more of a focus because of the tariffs and what they manufacture in China, right? The rest of the Mag 7, more of the communication names, they're in a little bit better space, but it's not as if anyone's in great space. It's not as if you can say, wow, this is a perfect spot, this is fantastic for these guys, couldn't be any better. It's just relative, who's worse, who's better, and who's going to get hurt a little bit more. Where's the defensiveness? Right now, what we're doing is everything is across a risk spectrum, and which one has less risk. That's all you're doing.
What's on your dashboard at the moment to establish where a tradable bottom might be? Is that impossible right now for you and the team?
No. So John, this is what we're looking at, because we see a setup. We don't see the bottom, but we see a setup, right? We want to see 1Q numbers reset. We want to see them cut. We want to see an inversion in the front end of the curve between 2 years and Fed funds of 100 basis points or more. That tells us that the market's indicating we need to move faster, you need to hurry up, and potential monetary policies coming. In addition to that, we want to hear the conversation become more productive. We want it either to shift from tariffs to taxes, or the acknowledgement that, oh yes, it's good. Everyone knows there's going to be pain, but the issue is they just don't know. The cure seems to be worse than the disease right now, or that's what the market's saying. You have to acknowledge that, hey, yes, there's going to be pain, but there's light at the end of the tunnel. Here's what we're doing. Here's our goals. When we get there, this is what's going to happen.
In the meantime, Delta withdrew its guidance for the full year. Walmart reaffirmed its guidance. What do you do with this?
So we actually had this conversation yesterday, and I've been having this conversation a lot. We expect numbers to come down. It's going to range. Some people, we were talking to our auto analyst, and he would not be surprised if there would be suspension of guidance there. We were talking to others saying, maybe it's going to be 5%, maybe 10%. What we're going to hear is the C-suite's going to say, out of an abundance of caution, here's what we're doing. We're lowering the top end of guidance. We're cutting 5%. We're cutting 10%. Because of the uncertainty, we have to remove guidance. So it's going to be right across the board. And you're right. The example of Walmart and Delta is a good one because you have the two ends of the spectrum.
This is where we really started the conversation. Where does the circuit breaker come from? Could it come from Capitol Hill?
It has to come from Capitol Hill. You have to hear the administration acknowledge what's going on, and you have to have them acknowledge and communicate that they see it, they understand it, and you have to have them start to slow things down. This conversation about a 30-day pause, a 60-day pause, a 90-day pause, something has to happen. You cannot continually walk in and have more tariffs and more stress in the system, because the more you do that, the faster we go to a recession, the faster job losses come, and the faster this gets out of control.
But right now it's just rhetoric. Do you actually see Congress pulling back the reins and trying to take control, giving less authority to the executive branch when it comes to trade policy?
Yeah, Emery, I think if it continues, you go down that route, but that's a much slower route. Right? And the market's going to move much quicker. And this is a question of confidence. Do the markets, do business folks have confidence in the plan, and what's the spill out from the plan? And right now, the markets are saying we're losing confidence, and we're losing confidence quickly. So
when it comes to circuit breaker, you think it's actually Republicans in Congress that could be the ones to put a stop to this? You don't see maybe it Xi Jinping or Donald Trump himself blinking?
I don't see in the conversation. So a couple things there, because that's a big question, right? The situation between China and U.S. appears to think that China is the existential threat. we can have that continue, and likely that does continue. But if we get positive news from the EU, from Japan, from other places where there is actually progress, then things can improve. China is toward the end of my concern at this point in time. Can we get our allies to come on board? Can we strike deals? Can we move forward? Can we make progress? If we're showing progress, the markets will react positively. If we do not show progress, the markets are not going to react positively.
There's a story in the Financial Times about how U.S. ports are getting really crowded, that a lot of companies are delaying their car shipments,
right,
and they're just holding them at the ports, hoping that maybe in a couple days these tariffs will be removed. Maybe it'll take 4 days, maybe it'll take 5 days, and they're about to reach capacity at these ports. What will it take for both companies and for the markets to realize this is real?
Listen, it's real, right? So the complexity of this, you cannot turn around in a couple days, in a couple weeks, because you basically tariffed or taxed almost every single country out there. In order to unwind that, it's no small feat. The other thing is, governments do not move quickly, right? And because of what we've done, people want to protect themselves. So they're going to have to talk to their lawyers, to their leaders, to their parliaments or whoever before they take some action. We can have the conversation, but the actual action and execution is going to take, I think, a long period of time.
What are we seeing in markets? Is this just the fear that this is going to have a suppression to growth, or are we getting actually a sense of what markets are repricing as the new normal?
Yeah, the markets don't really know the end goal, right? Is it negotiation? Is it revenue generation? Or is it something much bigger, right? Do we want to change the way we do trade throughout the world and for the rest of time? That's a big question. So the markets are just trying to figure out what's going on, and the markets are trying to send a message. We need better communication. We need to understand the goal. When we get to the goal, what are you going to do, and how are we going to do it?
To start that process, to engineer that supply side response, you've got to believe that these are the rules of the game. And we're still sat here saying, is this a negotiation, or are these the rules of the game?
I love how Chris puts it. The market is crying to the White House. We want better communication. Can we have a therapist come in here and try to clarify what the end goal is? Are we meant to be together? Are we meant to be apart?
Is this therapy again?
Well, it sounds like a lot of people are trying to get into the psychology of the moment.
What do people say? Cry harder. That's what we're doing right now.
I think that's what we're doing on every single market.
We've got to find some light humour in a moment like this one. We're down again by 1.4% on the S&P. A special thanks to Chris Harvey of Wells Fargo. Richard Bernstein of Bernstein Advisors writing, the Fed is caught between a rock and a hard place. GDP forecasts are being revised downward, but inflation expectations seem poised to accelerate. Richard joins us now for more. Richard, welcome to the program. You put it in your note. Everyone's got a plan until they get punched in the face. That famous strategist on Wall Street, Mike Tyson. How strong is that punch this morning?
I think the punch is a real, it's not a jab. It's a real roundhouse punch. And I think, John, look, you've been talking a lot about all the different uncertainties and all the different things that are going on. That's fine, but I think one also has to realize that we entered the year with investors historically confident. So this has a magnified effect on investors' confidence that they're being shaken. So that was my point about that everybody has a plan until they get punched in the mouth, because everybody had a plan. They thought it was easy. They thought this was like, oh, you know, let's just buy an index fund or let's buy the Mag 7. And all of a sudden they're realizing that was the unusual period, and now we're going back to something that's much more uncertain, and they're getting punched in the mouth.
Richard, Scott Bessent, Treasury Secretary, speaking with Anne-Marie, our own here, and saying that this then is not necessarily a MAGA problem, it's a Mag 7 problem. Do you agree? Is that basically what you're seeing right now, is the unwind of an overvaluation of a crowded trade at the end of the last year, beginning of this one?
Well, Lisa, I understand where he's going with that question, but my response would be, why is the Russell 2000 underperforming so dramatically here? If it were just a Mag 7 point, why are the most domestically focused companies in America, smaller companies, are underperforming, right? So how is this just a large cap MAGA effect? It's clearly not, or Mag 7 effect. Sorry, it's clearly not. I think this is a comment. The markets are making a comment on the broad economy in the United States, and I think also the notion that this is an orderly process. That's fine. I would agree with that, but the process is not a positive one. The markets are not giving a positive verdict on that, and that's kind of what I think people are still sort of missing here.
Richard, how do you navigate a situation like this where the rules of the road may be called into question over a longer period of time, and asset allocation potentially could look very different if the trends that we're seeing in markets today would hold? So how are you thinking about not just short-term investing, but the 1 year, 2 year, 5 years ahead?
Right. So Lisa, I think in the short term, you're using the word uncertainty. Everybody's using the word uncertainty. I shouldn't personalize it like that. Everybody's using the word uncertainty. So what that means is the scarcity in the marketplace is certainty. That's what will command a premium through time, is certainty. What does that mean? That means quality. That means more certain cash flows. It means dividends. It means really kind of focusing on near-term fundamentals as opposed to long-term growth stories. The second thing is, what do you do for 3 years, 5 years, 10 years, 2 years, whatever? And I think, look, the goal of what's going on, of returning industrial processing back to the United States and manufacturing back to the United States, I think that's a great goal. In fact, we've been talking about it at my firm at Ruchir Bernstein Advisors for 10 years. I wrote an op-ed in 2011 in the Financial Times about this topic and how important it was. The goal is real. However, the method that they're choosing to try and get to that goal, well, personal opinion here for a second, is incredibly ham-handed. There are many better ways to do it that do not place a tax on the U.S. consumer.
Richard, we heard from one ECB official earlier on this morning that said there's no reason for a rate cut right now. I think he referred to 50 basis point cuts as ridiculous. Mary Daly, the San Francisco Fed president, putting out a post on LinkedIn saying we have the time and space to deliberate our next moves. Lisa, that's what's different about this moment. These officials at these central banks aren't rushing to race in, rushing to step in and provide support like maybe they would have done a number of years ago.
And for the correct reasons, which is this is a very different type of crisis that is not of the credit markets making. This is about policy uncertainty and the potential stagflationary shock that comes along with inflation. If you take a look at 2-year break-even rates, they've actually hit the highest level going back to 2002 earlier this morning. It's shifting around, incredibly volatile markets, but the signal is not so clear in terms of how they should act, let alone if.
Richard, are you thinking about where pockets of leverage might be? This has been a really unusual cycle here in the United States and worldwide because of the support that was offered through the pandemic and through the recovery as well. When you think about where pockets of leverage might be this time around, how do you answer that question?
So John, it's related to what you and Lisa were just talking about. The Fed was spoiled for many, many years, three decades, by globalization. Globalization was a massive disinflationary force on the U.S. economy. Why? Because we were just increasing competition. And we all know when you increase competition, you put downward pressure on prices. So the Fed could play the hero and ride in on the white horse and save the day. Now what we're seeing is deglobalization. That whole disinflationary process is now being reversed, so it's now an inflationary process. That ties the Fed's hands, and the Fed can't play the hero anymore. And I think that's one of the things that's happening. So where is the pocket of leverage? I don't really know. One could argue that it's in the private market somewhere, because I think that a lot of their returns have been boosted by leverage and the ability to borrow cheaply to make acquisitions. Maybe that's where it is. It's certainly, not going to be, I would argue it's unlikely to be in the big banks. The big banks, for all their whining about over-regulation, big bank balance sheets are pretty strong. It looks like the regulation has worked. But where is that leverage? It's in things like private debt and all of that. So the risk hasn't gone away. It's just moved, I think, from the public markets to the private markets. It's an interesting monetary and fiscal question is that if there is some kind of problem in the private markets, They're supposed to be private. Will they come to the rescue? I would think they'd be very hesitant to do that.
The Treasury Secretary this morning is saying really nothing to see here. I feel like I'm going to sound like Lisa, but how do you think this bond auction is going to go today for the 10-year?
Well, a little outside my area of expertise. I just don't think, I think what we are seeing is a complete repricing of U.S. assets with a higher risk premium. Right? If you think about it, we've taken about 5, maybe 6 multiple points off the S&P despite good earnings. We're seeing in a very short period of time the 10-year sell-off. But certainly bond volatility has gone up, whether you agree with my statement about the risk premium or not. Certainly bond volatility has gone up. And I think what's happening is U.S. assets are being repriced. You mentioned before about, are we a safe haven anymore? Maybe not. And that's kind of what we're seeing.
I spy the Tottenham emblem right behind you as well, Richard. Super depressing stuff for you, eh? Appreciate the time, as always.
Rough season.
Thank you, sir. Richard Bernstein of Richard Bernstein Advisors. Thank you very much. If you are just joining us, these were the numbers. So basically what they've done is withdrawn their full-year guidance, citing uncertainty around global trade. The CEO, Ed Bastian, saying, quote, "It's very difficult to predict what policies may look like over the course of the year, that's for sure." The stock is up by 1.7% as Bastian adds that revenue has flatlined. Joining us now to discuss is Sheila Kahyaoglu of Jeffries. Sheila, welcome to the program. If Mr. Bastian can't offer any guidance, can you?
I don't think we can either. We cut our estimates earlier last week across the entire airline landscape, assuming flat domestic pricing for the year. What we're getting from Delta is suspended guidance, clearly, and that's probably the best strategic move from here. But it assumes something worse than that for Q2 in terms of flat domestic pricing, and then a second half capacity is flat. So not great news out of the U.S.'s largest carrier in terms of what they're saying.
Sheila, you've talked about this repeatedly. The high income bracket here in the United States holding up business for many of these airlines, premium, long haul. Sheila, are you seeing building evidence that maybe we're seeing something we haven't seen over the last 5 years, that they're starting to take the hit here?
I think premium and Atlantic or international are actually still holding up. We just got off the phone with Dan Junke, Delta CFO. It seems like the bookings visibility there is decent. What you're seeing the contraction is in the main cabin, which is where we would see it. But also notably corporate. Corporate really saw a move down in February and March. Industries that were particularly hit were industrials, aerospace, of course, and some other sectors, while financials and tech held in there, it seems. So corporate is also taking a leg down. So corporates are clamping up a little bit, whether it's the tightness in just, cost cutting, or if it's the macro volatility that's causing that is to be determined. So that's where we're seeing the premium hit is really within the corporate customer trending down.
We are seeing some commentary from Ed Bastian, the CEO of Delta. This in the Wall Street Journal. He said he understands there's a role to play with tariffs and trade policy. It's just hard when you're trying to do them all at the same time. He also said, "I don't think we're in a recession. I think we're in danger of talking ourselves into a recession." When you talk to executives, particularly from airlines, is there a level of frustration that the consumer does seem strong, willing to accept even price increases, still looking for experiences, at the same time that there's a lot of gloom and doom on Wall Street and a potential regime shift that could just torpedo that?
It's interesting because Delta's telling us they saw it within the consumer trend down really quickly, whether it was in February and March in the first 5 to 7 days of April. I'm actually in Atlanta right now. I'm at a trade show, an aerospace aftermarket trade show. And the 10 executives we met with yesterday were so confident regarding tariffs. They don't think it'll have as much demand destruction as people assume. And that pricing will actually be positive because they could pass it through to the end user, which is, of course, the airline, which is, of course, the consumer in the U.S. So I think we're seeing that short cycle hit with Delta this morning, a massive change with what they previously guided. They had guided a capacity up 4, now it's flat, and pricing also taking a swing down 2.5 to down 6.5 in their forward outlook for Q2. So we're seeing that major revenue cut, not only from a capacity perspective, but from a price perspective. And the airline's doing its best to stay profitable, show that it's, it's positioned well for this with its relatively low leverage, but they're only growing their net fleet less than 1%. So taking into account Boeing Airbus deliveries and their retirements, that's less than 1%. So they're clamping down on their costs as well.
This is a really fascinating dichotomy right now, Sheila, because on one hand, you have the airlines saying, ostensibly, they believe they have pricing power. They believe that they can raise prices and that you could shrink potentially just your flight schedule and keep prices where they are, go higher and offset any kind of change. You're hearing something so different from the likes of Walmart that want to invest in price, i.e. absorb some of the increase in prices. Is there some sort of structural change that gives airlines a strategic advantage to being able to have pricing power?
So the airlines are clearly saying pricing is stalling. Pricing and capacity are stalling. The aerospace show I'm at is more the manufacturers and the maintenance providers to the airlines. They're still seeing that they have the ability to pass price through. One is a shorter cycle buy. With an airline, a consumer booking is maybe 30 to 90 days, and that's where we're seeing the hit with Delta. The aerospace show I'm at is probably 30 to 1 year buy cycle. So the shorter cycle is definitely seeing the market volatility impact its demand and its pricing.
Sheila, Delta is a Virgin Atlantic partner on its North Atlantic routes. We saw Virgin Atlantic pull back some of those routes, especially when it comes to New York City, this major hub, JFK. Are you expecting more airlines to pull back some routes?
I think international is the region we're going to watch the most. So to put it in perspective, in terms of domestic is very important. Delta had previously $7.35 of EPS. Every 1 point of domestic pricing is about 85 cents to EPS. Internationally, every 1 point of pricing is maybe 20 cents. Internationally is still holding up, but what we're seeing there in the second half and into in Q2 and the second half is actually a decent amount of capacity, whether it's Delta, whether it's United, whether it's American. Capacity is up mid-single digits, up 4%. So if you have a lot of capacity, not a lot of demand, what happens? Your price gets cut. So Atlantic is still holding up strong in Q2. They're fairly well booked into April. I think 90% booked in April, 60% booked in May, and 40% in June. And that's system-wide, so internationally would be better than that. So right now, international is still holding up. But again, that's a longer sales cycle, probably 90 days instead of 30 days for the domestic side.
Sheila, appreciate your time. Thanks for jumping on. Busy morning for you, I'm sure. Sheila Kahyaoglu there of Jeffries. Headline of the morning so far. The tariffs go on overnight, as expected. The retaliation from China, raising tariffs on U.S. goods to 84%. To discuss, I'm pleased to say that joining us now is Ruchir Sharma of Rockefeller International. Ruchir, welcome to the program, sir. We are trying to work out what this Federal Reserve should do. Should the policymakers be stepping in and providing support, or should they watch and wait to see how this plays out?
Well, I don't think there's any case for the Fed to cut interest rates given its dual mandate just now, because as I wrote in my FT op-ed this Monday, which is that the Fed has missed its inflation target for 5 years in a row. It will do so again this year and the year after that, and possibly won't get to the target now for the next couple of years, even if it does nothing at this stage. And inflation is a big concern for Americans, and the rise in consumer prices over the last 5 to 6 years has been such that it has offset the entire undershoot of the 2% inflation target that we had last decade. So if you go back to the year 2000, over the last 25 years now, what you will see is that over that time period, consumer prices today are higher by about 16% than they would have been had the Fed been meeting its 2% inflation target over the last 25 years. So that's a serious miss on inflation, and I think it's aware of that. And given the fact that some inflation expectations are already elevated, to add fuel to that fire would be a mistake. So I think that the Fed needs to be true to its mandate, and it needs to sort of, at the very least, watch. And so far, there's been no evidence that its policy has been overly restrictive.
The pushback that I've heard over the past week, and I'd love your response to it, goes a little something like this. They should focus on the downside risk to growth and not the upside risk to inflation, because anxiety around the labour market is so much higher. We don't have sufficient tightness in the labour market that would drive those second round effects, higher wages, etc. What would you say back to that?
Well, this has been the same easy money crowd which has been, which is always calling for lower interest rates. So I think that that's been the real problem. One of the basic problems of the U.S. economy is that it's been fed on a diet of easy money for far too long, whether it's monetary policy or fiscal policy. And I think that's coming back to bite the U.S. And what's happening today is a demonstration of that, which is that I can't remember seeing a day in my memory where on the U.S. markets, all three major indicators are down: U.S. stocks, U.S. bonds, and the U.S. dollar. So there's a real loss of confidence happening here as far as the U.S. is concerned. This is almost like the kind of scene that I see in emerging markets, where you see cross assets declining together like this. And in emerging markets, I don't think any central bank would think about cutting interest rates in such an environment.
Do you think that we're getting a little ahead of ourselves with trying to give a narrative to the move in markets right now, given that there are basis trades unwinding and hedge funds that are deleveraging?
Well, it's still unprecedented. I agree that there's nothing that sort of extraordinary going on. If you look at the scenes we have seen in 2008, that kind of market panic, we are far from that. But we don't want to get to that point. So I think that the whole issue here is the fact that let's acknowledge that we have seen a very unusual move in asset prices, and that this accident in a way was waiting to happen. As you know, that at the end of last year, I had sort of called this the mother of all bubbles, this American exceptionalism trade where everybody was flooding into the American market as if there was no other market in the world to invest in. 80% of all equity market flows around the world this decade went into just America. So it's this big unwind taking place, I think, of that bubble. Now, you can argue that it would have happened regardless of Trump and tariffs, but his moves have obviously precipitated this. But as someone put it, that the air is coming out of that balloon, but that air was put in the balloon before that. And as I've argued in the past, the combination of very easy monetary and fiscal policies is what has got us into this place today.
How much further does it have to go then, if that's the theory that, yes, this is partly because of what's going on right now with policy uncertainty and the actual policies being put in place, but it also has to do with the buildup over so many years that you call a bubble. How much further do we have to go to create a level that you feel more comfortable investing in?
Well, I think that this marks a major regime shift, which is that the U.S. market had outperformed the rest of the world for 15 years, as you know. And in the last couple of years, that reached what we call a parabolic stage, where it just went completely vertical, where U.S. markets totally disconnected from the rest of the world. They, in fact, were sucking capital out from the rest of the world. So I think that this has many years to go, that what we're seeing today is the opening act of this major trend reversal in capital flows. But this is a multi-year trend, that people love to say that don't bet against America. The American stock market eventually always comes back and has been a great performer over very long stretches of time. All true. But if you look at those very long stretches of time, which go back to the year 1900 when we have data, that the U.S. stock market in 6 of the past 11 decades has in fact underperformed the rest of the world. And we've just had a 15-year incredible spell of U.S. market outperformance with both the dollar doing well and the U.S. stock market doing well. I suspect for at least the rest of the decade, both the dollar and the U.S. stock market to significantly underperform the rest of the world. So I think that this is a regime shift precipitated by what Trump is doing, but something which predates him.
In this regime shift, do you think we need to start worrying about potentially a firm blowing up like Melvin Capital Management did in 2022?
Well, I think there is a lot of leverage out there which we'll only know about when this happens. Like, what are the marks today for private credit, for example? Have they started marking their assets down or not? Private equity. So I think that there is a lot of follow-through action that we have to see. What we've seen so far is only in the public markets. My concern is that the longer this lasts, which I think it could, then you have to sort of start marking down private assets, and then we have to see what really happens, because that's where a lot of the buildup in excesses has taken place. So I think that, yes, we are going to find out where all the leverage is. And that's what the Fed should be doing now. It should be out there looking at where will this stress emerge of this big decline in public markets, because so much of the froth and so much of the excesses are lying in the private markets outside of the regular eye.
Second time we've heard that this morning. Ruchir Sharma of Rockefeller International. Ruchir, appreciate your time, sir.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.